Tuesday, December the 26th, 2017, to you. Finally, I can write about the Tax Cuts and Jobs Act signed by President Donald Trump on December the 22nd. Admittedly, I had been following up the negotiation process between the House and the Senate, but I had also opted not to write about it until the initiative was signed into law, as it is the case now. Roughly speaking, the tax reform slashes corporate tax rate from 35% to 21%. Also, one-time repatriation tax of profits in overseas subsidiaries will be of 7.5%, 14.5% for cash, thus encouraging companies to bring their money home over time, but at much lower rates. As for individual income tax, the top individual rate, that is income tax paid by households who earn $600,000 and up, was lowered to 37%. The bill also nearly doubles the standard deduction from $12,700 to $24,000 for married couples and from $6,350 to $12,000 for single filers. The new tax law doubles the child tax credit from $1,000 to $2,000, $1,400 of which will be refundable. So that reform is great if you are rich or you want to have a baby. Anyway, Mr. Trump, at last you had a major legislative victory. Cheers! This legislation contains $1.5 trillion in tax cuts. But how will this reform impact the US economy? Many economists believe the bill will provide a boost to the US economy in the short term, but eventually its impact would fade. The Joint Committee on Taxation said the bill would increase growth by merely 0.8 percentage points over the first 10 years. For its part, Goldman Sachs estimated the GDP would increase 0.3 percentage points above their baseline in 2018 and 2019. And for my part, I'm quite interested to know how tax reform like this one can effectively stimulate the US economy. Classical economic theory sketches out the mechanism through which tax reduction boosts economic growth. By having to pay less taxes, disposable income increases, and so consumption and investment. Consequently, aggregate demand rises and economic growth increases as a result. However, proponents of the recorded equivalence say that the present value of fiscal revenues must equal the present value of fiscal expenditures given the government budget constraint. Accordingly, present tax reductions must be followed by future increases in order to finance the resulting debt. Economists propose that households do not behave considering future tax raises, partly because their life horizon is shorter than that of the government. But is this reasoning applicable to corporations too? In my opinion, this reform could provide a good answer to that question. US public debt is too high already, 76.5% of GDP, so a tax increase can be around the corner. The reform pushed by President Reagan in the early 80s was sustainable because America was not that indebted back then, but this Trump-anomic idea will not last for long. In short, corporations should not change their decisions as a result of the new law. I have some words on the individual income tax as well. Will it encourage job creation? I have my doubts. It is uncertain whether the wealthiest households will spend their increasing disposable income in consumption goods, and even if it were the case, will ignore how these households will spend their money. Rich people do not tend to buy labor-intensive goods. They often spend their money in items which use high-skilled labor, jewelry, luxury cars, or in services, tourism. Perhaps a good stimulus for job creation would be to cutting taxes to those who customarily demand labor-intensive items. In other words, the middle class. At last, Mr. Trump trumped. Alas, the world is still on.